You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, that fun tune means it is time once again for Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as from this here ever-expanding, ever-exciting, ever-compelling Options Insider Radio Network. If you haven't checked out our latest edition, Options Oddities, I encourage you to run, don't walk, to wherever you find our finer Options Insider Radio Network programs, including the mothership, theoptionsinsider.com, as well as iTunes, Stitcher, Aha Mobile, and even our mobile app, available for iOS, Android, and the Fire OS. You can listen to all those fun episodes where we break down all the cool, unusual activity going on in the world of options. So check it out. Options Oddities, available wherever you find this fine program. All right, and speaking of this fine program, I am joined, as always, by my two volatility compatriots, starting off with the man beaming in from the heart of finance, at least when it comes to stocks and bonds. That is New York City, Mr. Jared Woodard, beaming in from the HQ of BGC Partners. Jared, welcome back to the show, sir.
Mark, it's a pleasure to be with you, as always.
All right, glad to have you on the program. And also joining me, beaming in from the heart of all things VIX mentoring, that is the Option Pit HQ. He is the greasy meatball himself, Mr. Mark Sebastian. Mark, welcome back to Volatility Views.
Hey, good to be here, Mark. Can't tell you how excited I am to be talking vol on what has been an exciting volatility week.
It has been a good week to talk about some vol. So I think without further ado, we'll get right into it and dive right out into our volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, that fun tune. Every time I hear that one, I want to just keep the song playing so we could rock out a little bit here on the old show. But, of course, we have some important vol business to get to. And as Mark alluded to, it has been a very interesting week from the volatility, trading, and analysis perspective. We are, of course, recording this, listeners, Friday, October 3rd. You're probably listening to it on Monday or any other day thereafter. We don't mind when you tune in, just as long as you do. And, of course, it has been an interesting week. We saw quite a bit of up and down, back and forth action, the markets retreating and then gaining it all back in the same day. And now today, of course, on Friday here, we're coming off the heels of non-farm payrolls, and the market liking what it saw, up about 1% or over 1% in some scenarios, getting back close to that perilous 2000 magnet strike. We're at 1966 right now. in the S&Ps. And, of course, as you might imagine, given all this love, all this upward movement, given the weekend and the unwinding of the non-farms event such as it was, VIX cash taking it on the chin, down about $1.50 right now to 14.66. I should say 1.5 because it isn't really a dollar value. I just like to throw it out there sometimes just to throw some red meat to Mr. Mark Sebastian. Speaking of red meat, Mr. Sebastian, there's a lot of grist for the mill this week from a vol perspective. What caught your eye the most?
I mean, you know what was really fascinating is you could see the writing on the wall. I actually think we talked about this last week. Where we basically kind of all concluded that vol was going to go up till like Wednesday, and then they were going to dump vol on Thursday, and we were going to get a pop and a meh in non-farm payrolls. And, you kind of figured the gig was up on Wednesday when the market was down, and I'm sure Jared will be able to speak to this more too, but the market's down 26 handles, and the VIX is up 0.4%. Then we come in on Thursday, and at its peak, the market's down 20. The VIX is only up, maybe a little bit more than $1. And despite basically ending flat on the day, and over a 2-day period dropping 26 handles, the VIX over that 2-day period loses 0.1%. You pretty much saw the writing on the wall that we were going to be going higher, and that's what happened. I mean, the market is booming higher today. The VIX futures are getting plastered. The VIX is getting plastered. And, like you said, I think we're going to make a run at that 2,000 level again before we figure out whether we're going to turn around. But, one key thing to keep an eye on when the market is having these big sell-offs and vol just isn't moving, that is people selling puts. All right. The market down 26 points and VIX up 0.4%. All right, Jared can give you the stats on this, but to me, and to basically any professional, that basically tells us that volatility is actually in. And I'll pass this off to the brains of the operation, Jared, and let him expand.
Well, thanks, Mark. I can't disagree with you. When you got this big move, and while the coverage and sentiment anecdotally seem to me pretty intense, the numbers don't bear out the kind of genuine panic that we've seen so many times in the past, and the fact that volatility has come in so hard today in implied terms, it just kind of confirms that people haven't broken out of the pattern of sort of buying the dip, selling vol in the dips when it spikes. That is, it seems like more of the same. Although I have to say that the trend over the last several weeks cumulatively has been really fascinating if we kind of incorporate changes in cross-asset volatility and not looking just at equity indexes. There you do see, I think, a pretty discernible trend higher. And the question, I think, now is whether that's going to continue, A, and B, whether that's going to start to bleed into equity implied vol in a more meaningful way in the weeks ahead.
Good points, everyone. And you're right, Mark. It is, of course, a good sign that people are indeed selling vol. It's kind of like the flip of the script. People ask us a lot on other shows and this program as well. What does it mean when the underlying is rallying and the VIX is up? People are buying calls. In this case, the other days when the market's selling off and the VIX is not really popping, people are taking advantage of that opportunity to blast out some puts. Speaking of which, we did have a decent range, as Mark and Jared both alluded to, in the VIX cash realm, ranging from a high of earlier this week, nearly just a tick under 18, all the way down to, I believe we're actually below that right now. We're at the lows of the week right now, 14.65 right now in the VIX cash. So non-farms taking what was left of that juice. No longer are we flirting with the high teens with an SPX or approaching 2,000, which is crazy in and of itself. We're coming off quite a bit as a result. Also talking about the futures. Futures had some interesting movements again this week, cooking stuff out in the futures. But what caught our eye this week, as is always the case, is a lot of interesting stuff cooking in the realm of VIX options. In particular, of course, a lot of you guys still love it when we talk calls versus puts. That, of course, is coming in quite a bit, as you might imagine. Talking about 3.5 to 1 now. We're down almost a full point from where it was. It got up to highs of right around 4.4, I believe, recently. So that's coming in quite a bit. Not surprisingly, given as the VIX rallies, you do actually have more physical strikes to the downside that people can trade. So that indicator is going to come off a wee bit, looking at what was lighting up the tape for people over this past week. The hot strikes are, surprise, surprise, once again this week, all the top 10, all calls. The Dees, I think it was the Dees 13 puts last week, holding the number 10 spot. We say what happened this week, and of course, they got squeezed out as expected. All calls all the time, starting with the Nov 20s to the tune of 351,000 contracts open on that strike. Then down to the Oct 17s, 340,000. Oct 20s, 317. Nov 17s, 250. And then the Jan, get out to number 5 spot, takes a little bit longer term look. The Jan 20s, 245,000, then back to Oct 21s, 18s, and 19s, and 22s for 242, 238, 218, and 213,000, respectively, and bringing up the bottom of the top 10 there. A little bit of Nov love, the Nov 23s to the tune of 181,000 contracts open on that strike. So quite a bit of a drop-off from the number 1 spot there to the number 10, pretty much roughly 50% at that point. Total outstanding, we're seeing about 7.88 million options, fairly robust, as you might imagine. 6.14 on the calls, and nearly 2 million on the puts, so getting a little bit of love more on the puts. And talking about some interesting trades that caught our eye out there, if you were paying attention to the flagship, theoptionsinsider.com, you would have seen we profiled quite a few interesting VIX trades this week. I just pulled a couple of them to talk about here on the show. Certainly the largest from a size capacity was this mega trade on the Oct 19s, going up 457,900 times for 86 cents. They traded out of sequence, as you might imagine. Also, in one mega block, not surprisingly, also we saw a big jump of an implied vol on that strike. With any kind of print that big, you're going to see all kinds of distortions happening as a result. And that certainly was one of them. That might be the largest single trade we've ever profiled going up in VIX. I'll have to dig into that to make sure that number is exactly right, but still interesting stuff cooking in VIX. And we also saw Nov calls getting some love as well, to the tune of about 55,000. People trading near the bid there, so it looks like they were sold out, actually. And looks like they were pretty much closed after we saw that spike earlier this week in vol and in the VIX. This guy taking his money off the table. We profiled them earlier in the month, buying some stuff out there in October. So clearly a lot of interesting love. Jared, either of these trades make your radar, and how do they compare to what you were seeing over there on the OTC side of the fence?
Yeah, so one of the things I noticed last week was that there was a little bit more activity, and I would say reactivity in the upside VIX calls on less dramatic action than we saw this week, certainly, where you had, regressing, like a change in the upside call volatility was just a bit larger given relatively modest moves in the spot index than we had seen historically, certainly over the last several years. And so it looked like people were buying those calls a little bit more aggressively than normal last week. And those traders probably were really happy about that this week. On the OTC side of the fence, I was looking at variance swap data reported by the DTCC for S&P 500 variance swaps, and activity this week seemed pretty robust. Some of the data in here is not as clean as it is in other reporting places, but at least in terms of what's on Bloomberg, the total for the week was about 684 million notional traded, and of that, about 20%, about a quarter of that or so, really was in December. And as you can imagine, people were lifting bids in a lot of these swaps earlier in the week when volatility really got going. But some fairly big prints for December contracts. Most of them, in the largest one around 62 million, if that print can be relied on, and the levels were around the 16 quarter handle. So some pretty big moves there. I think it fits with the kind of reaction that we saw in VIX options markets.
Yeah, whenever you see a print as big as we saw in the listed VIX products, something is afoot in the OTC realm. There's no way something like that went up just by itself. It has echoes and mirrors in other parts of the volatility landscape. Speaking of that landscape, Mr. Sebastian, what's your take on all these crazy prints going up in VIX land this week?
I think a couple of things. I think it was people taking profits and people calling a top. I mean, that was, the final piece of as I was watching VIX trade and I was watching the flow, kind of the final thing that convinced me that we were going to rally was when VIX vol was coming in with the lack of VIX movement. So, you shouldn't see, VVIX correlates, in my opinion, kind of better with, as a real panic indicator or a real hedging indicator than VIX itself. So that one should be spiking when the VIX is making somewhat dramatic moves. And to see that being sold on Wednesday and Thursday was just another sign that, everybody kind of figured the gig was up. And that's my general thought process.
Seems like that's what we're seeing out there in S&P vol skew as well. You'd think that this might be a time people would be bidding up some protection. It seems like it's actually coming in a little bit. I'm looking at the chart here for the E-mini option skew, but you can pull that from across all the different products, and it's roughly parallel. And we're looking here, the nearer term stuff, of course, fairly steep, but once you get a little bit farther out there, actually it's a little bit flatter than I expected. And just to confirm that, I looked at the old CBOE skew index, of course, published once a day by our friends over there at the CBOE. I would love if they would do this in a real-time basis, and maybe someday they will. They will hear our plaintive cries. And it's actually been coming off quite a bit since about the 19th of September when it hit its recent high of 146 out there in the CBOE skew index. We've been trailing off ever since as a result, getting down to, as we speak, as of yesterday, of course, listeners, because this is a trailing indicator here, 125.35. So off the lows we hit the day before of 123, but still way at the low end of that near-term range. Jared, does any of this surprise you, given the activity we've seen out in VIX and S&P land, that the puts actually not catching much of a bid? This kind of relates to what Mark was saying before, that in those downturn moments, people took the opportunity to actually come in and hit those bids, and this data seems to indicate that.
I think that the action is just as surprising as the move in the markets, which is to say, sometimes when we see a dip in the market, there's some reasonable, plausible, approximate cause. And I think what was unusual this week is that it looked like a reaction that even if you were willing to tell stories about why markets move, which, hey, look, I think we're all reasonable critics of a lot of the storytelling that goes on. But even if you look for some kind of a plausible explanation, there was no one thing I think worth fixating on this week that justified the intensity of the sell-off, and so it may just be that some very timely and eager volatility sellers and just equity traders were willing to come in and say, look, this is too big of a reaction on no real reason with strong economic data. This is premature, and in that sense, using this opportunity to sell some downside puts and kind of reload on volatility trades seems like absolutely a reasonable kind of reaction to see.
It's funny. That's my favorite narrative of all of the broad financial media. It is the try to find a narrative to fit what we're seeing in the market today. And you're right. I think all of us here are rightfully skeptical of that. Not to besmirch our friends, the beat reporters. They have a rough job having to summarize all that activity in a few minutes with a quick, short piece. But c'est la vie. It's not exactly the easiest thing to do. I think the guys who used to give me a hard time when I first walked on the floor of the CBOE saying more sellers than buyers, more buyers than sellers, when I, bright-eyed and bushy-tailed, used to try to search for greater meaning in the moves, they were usually correct. And now, diehard cynic that I am, I have embraced that philosophy as well. Of course, we did see some events this week that you'd think may be potentially market moving, including, like I mentioned, the non-farms. And going into non-farms yesterday, we saw a little bit of paper in VXST. That's, of course, the VIX short-term product, a product that was pretty much created for events like the non-farms. And we've talked many times in the past on this show about how hasn't really seemed to resonate around those events for a variety of reasons. And it seems like that's the case again today. We saw a little bit of paper, I believe about 1,000 contracts going up yesterday. Most of that seemed like it was a closing trade. And today we're looking at 117, a whopping 117 calls, 117 total options, 110 of those being calls going up today in the wake of non-farms. So clearly people aren't rushing to take stuff off after the non-farms event, kind of like a big shrug. They're averaging about 900 or so contracts out there with an open interest of about 4,000 and some change. The top strike, lighting it up, is indeed 1,000 lot of the October 19 calls expiring on the week of the 8th there. That's actually, I believe that's the 1,000 lot I was referring to. That actually was opening. But that's really pretty much about all we saw. The rest drops off precipitously from there. The number 2 strike being the October expiring on the 8th, 20 calls, and then 500 of those, and then the OC 15s. Got some puts there, 250 of the OC 14 puts also finding some interest, a little bit longer term, expiring the week of the 22nd. But aside from that, it really just drops off. You're talking 50, 60, 40 at that point. So not a lot of love still for VXST. Mark, we've talked about this before on the show. I can't imagine this comes as a big surprise to you, but yet again, I'll toss it to you. Does it surprise you at all to see not a lot of activity around non-farms in VXST?
You know, eventually there will be if the product takes off, and especially if the VIX adds weeklies. I think that'll create some more interest in VXST as a whole. Yeah, I mean, you know, one of the things with this product is you know, with vol already kind of high, I think it's kind of hard to do anything. The fact that they traded the 1,000 lot, I think, was ahead of non-farms. I mean, that's the biggest right in front of a number trade I think we've seen. So, you know, congrats to them. Hopefully, you know, we'll see what the product ends up doing. You know, the problem is there's no liquidity in the futures, which makes no liquidity in the options. So, you know, we'll see where this thing goes long term. Like I said, I think getting some weekly VIX options will maybe help out with some of the VXST stuff. You know, they'll have something that maybe is a little more cross-hedgeable than the VIX itself. So that's probably why we didn't see anything. And you know, Mark, actually, I wanted to bring up the skew index. I had a conversation with SIBO. You know, Matt Moran says, you know, hey, what do you think about this? What do you think of skew index? I said, well, I looked at him. I said, well, I think a lot more of it if it had any type of intraday quotes. And, you know, so I actually went down and talked to research for about half an hour. And what I told them they were like, well, the problem is it gets way too noisy if you do it intraday. And I said, well, you know, you do these BXY and BXM and put indexes on a 5-minute VWAP. Why don't you do a 5-minute VWAP or a 1-minute VWAP or a whatever of the quoted prices, and then you'll end up actually getting a smooth skew index. And lo and behold, they actually thought it was a good idea. So hopefully that's something coming down the line, even though you know, at least they'll take some time to look at it, because it could be an interesting index. My guess is that if we had a dynamic skew index yesterday, it would have been going up all the way up until Monday, and then on Tuesday and Wednesday, or Tuesday probably flat, Wednesday we would have started to see the skew index fall as traders were selling basically hedges into this market sell-off. And so that's another thing, is that's part of what I think causes vol collapse, is that people were looking at that sitting in between the 100 and 200-day moving average and saying, you know what, I did this hedge, it worked, time to sell.
Think about how much insight into the markets that could give us just by looking at that, even a 5-minute VWAP. You could see when that influx of selling started right there.
Yeah,
you know,
that
it would be
super
awesome.
Valuable.
It would be extreme. That gets back to what you're talking about, Jared, about creating that narrative. It'd be a hell of a lot easier to do if you had that sort of data that you could mine at a moment's notice. So there you go. Maybe all of our complaining on this show, Mark, will finally come to some fruition. Like, I've kind of washed my hands of that debate. I've said it to him many times, and nothing's happened. So I just assumed they were content with their once-a-day dissemination. Maybe your tweaking of them will point them in the right direction. Let's all hope. I'm assuming the listeners of this show would be behind a much more frequently released skew index. We touch on RVX really quick. Not a heck of a lot going on out there. As you might expect, that divergence hasn't really emerged yet between Russell and the VIX that seems to really make this product sing, and the ETPs are still in the works. So as a result, we have about a couple hundred contracts open here or there on different strikes, 200 on the most. The OC 29s being the charge leaders followed by the ever-optimistic Oct 30s, and then it kind of falls off a cliff from there. Not too much open on the rest of those strikes. So as we are wont to do, we always like to delve into some other products that also exhibit a little bit of vol here on the old program. Kicking things off in the shiny realm, the shiny stuff. This is indeed gold. We've talked on recent shows looking at a lot of this gold skew and what's been going on out in the gold vol land. And as you might know, listeners, gold vol spiked and it came off. Then it's starting to tick ever so slightly back up again. We're seeing products like GVZ starting to have a little bit of an uptick over the past couple of weeks. Nothing too aggressive, but enough of it's reversing that downward slope that it was on. Also looking out here at the big futures options, and we've talked in the past about how relatively put heavy these products are, and that is still the case this week, listeners. All the juice is out there in the put land. Looking at roughly a 16 or so, 14 to 16 range in the implied for the at the monies, and it gets off the charts to the downside there once you start buying some puts as high as in the 20% or more range for some of these products. So people still loading up on the puts out here in the metal. Same story in the silver as well. Of course, we're seeing a very similar chart. If you superimpose the two, they would look very similar. A couple of weeks back, silver had no real bias at all to the vol skew. It was pretty much the straight-up commodity smile you see in a lot of these products. These days, you're seeing bias to the downside in the puts as well. So clearly, that hasn't mitigated at all since the last time we gathered here around the old Vol Views panel. Jared, I know you watch a lot of the commodities. Does that surprise you at all that people are still worried to the downside in the metals, or is that pretty much as you expected?
No, I mean, if anything, I can't imagine why people aren't bidding up downside strikes in gold even more so. The 90% put or something I was looking at earlier today. 90% put implied vol right now and over the past week is even past 2 weeks was mostly unchanged. Up a bit certainly versus where it was a month ago, but you're not seeing much movement in those downside strikes on a relative basis over the last week or two. And given the what a lot of people are regarding as potential long-term momentum and trend lower in precious metals, especially gold, as the whole economic picture changes and the kind of gold bug thesis seems decisively, perhaps once and for all, given a death blow. I think that there's a very, very strong fundamental case that a lot of people are trading based on. So the fact that the downside skew isn't more extreme is actually a little bit surprising to me. I wanted to jump in though on RVX and the Russell, going back to your comments there, because I was looking at this week as well, and we've been talking about the underperformance of the Russell 2000 and small caps in general this year versus large cap stocks, and that theme is pretty familiar. What really caught my eye though was that in risk-adjusted terms, it's been pretty striking lately. So I was looking at the beta of small caps to large caps, looking at using like a 6-month window so we can get some smooth data, and the beta, just the covariance of the two over the variance of the S&P, climbed to about 1.4 in recent weeks. It's been about 1 1.35 really since the midsummer. What was notable about that was that this big rally in Russell beta was the highest level since the fourth quarter of 2011. So you had, although Russell's been looking poorly all year, that's really accelerated in risk-adjusted terms. And as a result, we saw the term structure in Russell and IWM flatten much faster than it did for the other major indexes in this most recent sell-off. All that to say, if there's a good opportunity to trade some kind of relative value or some kind of a thesis on Russell versus large caps, this sure seems like a good situation to do that. So I was a little bit surprised that we didn't see more of a pickup in the RVX products this week.
Yeah, you're saying it's actually more interesting than even what it was earlier this year and like into Q1 when we saw a lot of interest out there in Russell land and driving a lot of comparative trades between the VIX and the RVX, like the straddles and strangles we were seeing. And you're right, I was kind of expecting a little bit more of a bump this week as well. And when I started parsing the numbers, it's just not materializing. So I'm not sure if they need even more they need more of a divergence, or they need an ETP, they need the underlying to do a little bit more, whatever the case may be. I don't know what it is that is keeping people on the fence out there in RVX land, because you're right. I would think the situation right now is as favorable as it's been for at least in the near term, and yet we're not seeing the love as a result. Before we move on to the energy realm, Mark, I know you guys over there at Option Pit look a lot at the GLD and the GVZ and the SLV, as well as the RVX and the Russell. Anything catch your eye out there from a vol perspective over the past week?
I'm right in line with what Jared said. I think that it's going to be a rough go of it for gold for a nice period of time, and that is not – especially with the rallying dollar. I think you're going to see gold vol rallying, and I think we got a real shot at sub 100 gold sometime in 2015 if the dollar keeps rallying and the Europeans are the ones that start really printing the dough.
You weren't here for our epic GVZ futures debate. I think it was Andrew on for that one.
Oh, jeez. No, thank you.
Where I insisted that it existed, and Jared and Andrew...
No, they exist. They
exactly.
just don't trade.
They don't trade, but Jared and Andrew, I think, called that into question. Maybe a day like today might finally give us a one lot.
They do, in fact, exist.
I'm looking here at the numbers. Yeah, about 623 open on the options. I haven't pulled up the futures here. I'm wagering...
Probably 3.
Yeah, I'm wagering the futures are substantially lower there, listeners. Moving on to the energy realm. And some of these charts we're seeing out here before we get into some of the more esoteric products than the oil and the crude, as you might imagine, also showing some downside love here. We talked about this last week, crude being very, very put heavy, and we're continuing to see that be the case this week as well, with these downside puts, even in some of the longer term products, getting well out into the mid-20s pretty quickly from an implied vol perspective in terms of what it's going to cost you to actually hedge some downside in these crude products. Jared, do you have the same, I suppose, disbelief for crude as well? You think crude puts should be more expensive as well, or are they perhaps more in your sweet spot?
That's a more complex picture. And it seems like there's been a consensus lately that this decline in crude oil is driven by greater than expected supply. Although I did see one article arguing from the demand side this week. But I think the picture there is a little bit more complicated for sure, and that for looking at energy, I think is where we can turn more towards some of the longer term view, meaning in my case 6 months. And there I think it's more about the overall story in currencies and commodities and fixed income as well, where overall those products are seeing higher implied vols in a kind of a sticky, slow roll kind of a way. I think even if you filter out the noise and the trend from crude oil prices, options are starting to get priced higher across the board, not just in WTI, but in Brent and in natural gas as well, and well into the rest of the commodity complex. So I think that there's this is just a personal view, but I think that there's a trend that's starting to build in this area of the market that will probably still be around even if oil finds some stability and even starts to move in the other direction.
Yeah, it is an interesting story, and you're right. There is a debate to be made on both sides of the fence in oil. Is it supply? Is it demand? Seems like the true story is a wee bit of both driving that sell-off out there. We'll see if we can continue to test and head south of that 90 handle. And it looks like, given the option flow, people are betting that we just might be able to do that. A few of you have written in saying, hey, what about some other energy products like nat gas? So we threw those into the rundown this week as well. And nat gas kind of showing a little bit of a flipping of the script compared to pretty much every other commodity product we've just been talking about that are all puts all day long. And nat gas, perhaps not surprising to those of you who've been watching it and trading out there of late, even though it came off a little bit recently, given some more favorable than expected reports. But nat gas looking very, very heavy from a call perspective. A lot of guys prepping for perhaps some longer term pops. Looking at this is the nat gas, the American contract we have here, but the European is a very similar setup here from a vol perspective, and it's looking not so much put heavy as call heavy, with a lot of the at the money strikes hovering right around a close to a 40 vol there. So pretty hefty from an overall implied vol perspective, and getting fairly rich once you start looking for some upside out in nat gas land as well. So we'd like to throw that into the mix a little bit to keep an eye on. We'll certainly do as the weeks go ahead to see if this skew shape is an aberration or if this is indeed the shape of things to come, pun intended, out here in that gas land. Meanwhile, a couple other of you have also asked about fixed income. We talked about the new VIX product for the fixed income vol, and looking at the 10-year vol. This is where we get back to more of the more regular type of commodity smile that you may be used to looking at a lot of these products. In no particular bias either way, really. That is a little bit maybe you could claim on the call side, but nothing really too aggressive here. So the smile, I guess you can say, never really left, but you can say it's back out here in 10-year land. Jared, anything surprising you out here, either in nat gas or in the 10-year vol?
Yeah, nat gas, both the NYMEX and the European contracts the options are priced at about their 3-year median levels. So certainly not at the low end at all. And in fixed income, we saw pretty notable bids in implied vols in recent weeks. There's a lot of products actually that are also priced at or above 3-year median levels of implied vol. So it's the front of the curve as you expect, but from euro dollars to the 2-year, I think even the 5-year is priced higher, and options on Euribor products over in Europe are priced more expensively as well, as you can imagine. So that fits with that overall story I was referring to earlier, where you have it's still in early stages, but I think a persistent, real legitimate bid where you've seen implied volatilities rise in a lot of these products in a way that's kind of become persistent week after week. We actually titled our note this week, Preparing for Regime Change, referring not to regimes, political regimes around the world, but to the volatility regime. And so this is something I'm paying quite a lot of attention to, as I think it could be a major theme for the next several quarters, and we're certainly seeing that in fixed income. And in currencies, too, you've got the Australian dollar, the Canadian dollar. Obviously, Brazil is driven by those electoral concerns, but a lot of places in currency markets, too, where options are finding a bid.
Mark, I know you watch a lot of fixed income, mostly on the ETF side, like TLT, which is, of course, the 20-year ETF there for iShares. Anything out there catching your eye over the past week?
Yeah, like I said, they've been running vol up kind of across the board. The SIBO's really getting stoked for this VX TYN that they're pushing out. I think that, yeah, bond vol's starting to move. If you talk to the guys in the Eurodollar pit, they'll tell you they're finally starting to see some activity and some real uncertainty as to where rates are going to be 2 years from now, which has not been a theme for the last 5 years. So the activity is really starting to pick up in the Eurodollar options, and activity picking up there shows that there is going to be some more uncertainty in bonds. Bonds start to move, that's going to affect the stock market, especially if they have a violent move. You get a violent move in the bonds, it will be met with a more violent move in the equity markets. That's kind of my guess. Maybe not in dollar terms, but in terms of wickedness, if you will.
Wickedness, I like it. A wicked move, perhaps.
A wicked
on
move.
The horizon.
We're all from a Boston-esque move.
We'll save the madcap prognostications for the crystal ball, sir, but I like it. I think I know where you're leaning. That laugh means Jared agrees as well. And Jared, before we wrap up here on the volatility review, I know you like to crack open your international volatility tracker to peer farther afield than just our domestic markets here, but see what's cooking around the world. We had some interesting stories in recent weeks, of course, Scotland and the Middle East and others. So what caught your eye from an international vol perspective over this past week?
This was a legitimately perplexing and I think interesting phenomenon that I wrote about this week. The implied volatility around the world did not behave on a relative basis, in ratio terms, the way that I think the way I certainly would have expected if you'd asked me, if you'd showed me realized vol for current day 1 or 2 weeks ago, I would have not expected this. What happened was, emerging markets have been much more volatile in recent weeks on a realized basis than developed markets. Everybody knows that. But typically when we see that happening, we find that implied vols kind of move in lockstep. You see, big moves higher in the options markets that kind of match the magnitude of changes in realized vol. But we didn't find that this week. Instead, we kind of had the reverse, where developed markets, especially U.S. and Japan, the options were priced at what looked like relatively expensive levels compared to. So what happened was that developed market implied vols, especially in the U.S. and in Japan, remained high and rose quickly to such a level that it looked pretty expensive compared with the realized volatility in the underlying indexes. And that didn't happen. It's actually the opposite happened in emerging markets, where, as the realized vol started to pick up, option prices moved higher, but not as quickly or as far as we would have expected, leaving you with a weird situation where it looked like developed markets, where the economic data is neutral to very good. The options looked expensive. In emerging markets, which have all kinds of troubles depending on which country you're looking at, the premium seemed relatively cheap. And so there's some natural trades that suggest themselves potentially in that kind of an environment. And it was just something that we haven't seen occur very often this year at all.
All right. Thank you for that, Mr. Jared. And now it's time to let you guys join us here on the Old Vol Views panel. It's time to open up the Volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the Volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, welcome to the Volatility voicemail segment. This is indeed the portion of the show, like the man said, where you guys get to join us here on the Old Volatility Views program. Make your questions and comments heard to your fellow listeners as well as to us here on the old show. Going to kick things off with a listener goes by the handle Crazyhorse. He writes, or she, I shouldn't assume, can't some of the roll yield problems suffered by VXX and others, I'm assuming he means other ETPs, be solved by either 1, rebalancing on a less frequent basis, or 2, trading I think he meant to write basket here, of futures as opposed to simply buying the long-term contracts every time? Interesting question, Crazyhorse. This is, of course, a topic we've delved into with some frequency in the past because it is such a big problem for so many of these ETPs. And we've seen people try to do almost exactly what you're talking about here in a variety of different products. The problem with rebalancing less frequently, one, of course, is that it's not going to track the underlying as well. That's kind of the reason that they rebalance. And we've seen a variety of products come out that have tried that basket approach in a variety of different formats. Some go middle of the curve. Some will try to spread it out across the whole curve, like you're saying, a little bit of short term, a little bit of medium quote term, a little bit of longer term futures in there. And none of them really have been able to solve that problem. Because at the end of the day, you still have that same inherent guesstimate factor that you're working in wherever you're putting your contracts on the term, is you're locking in that vol level, and if that term structure changes and those vols change, that's going to cost you at the end of the day. So they may suffer less from roll yield, but I haven't seen a product that seems to have the silver bullet yet. Of course, we haven't seen the Wiley product yet. That's essentially that entire product's claim to fame, is that it's not going to have the roll risk problem. We'll see when that product sees the light of day if that is indeed the case. Right now, it's all hypothetical. Mr. Sebastian, we'll start with you. What do you have to say to our friend here, Mr. or Mrs. Crazyhorse?
Yeah, I mean, I actually think you're going to exacerbate the problem by rolling less frequently. You know, what I kind of point people toward is that, and Chris Cole can talk about this, instead of trying to, a couple of things, instead of trying to constantly have on this big hedge, and this was actually one of when Jared used to run his own volatility hedging thing, this is what he'd do. Volatility, especially when it's moving higher, correlates really well. And so you can go from, in pretty good efficiency, go from a small position to a big position pretty quickly, just buying vol into increases in volatility. In addition, there are some products that try and be kind of net long Vega but short roll yield that have some semblance of being okay products. But I think the smarter way to do it is to have a smaller position and ramp things up as things increase. And I can guarantee you my friend Jared is probably going to agree with me.
So you're saying essentially don't carry as much and just be quicker on the trigger finger when things pop.
Not even quicker. Just develop as the market moves, move into more vol. And that's the smart way to approach volatility hedging, because basically every study out there says you should be short volatility until volatility really blows up, and the time that you think you want to be shorting volatility is when you should be buying it, and the time when you think volatility is cheap is the time you need to sell it, and that we've seen that over and over and over again. The VIX futures are the best buy when they've moved from 20 to 23 or 23 to 25 statistically, than when they're at 14 or 15.
Jared, point, counterpoint, agree, disagree. Where do you fall on this great spectrum of debate, sir?
Look, I got to endorse everything Mark just said on the practical side of things. He's exactly right.
All right, I'm canceling the show. Then that's it. You two are agreeing far too much for my taste. That's it.
Well, let me add a conceptual point here, because I noticed. I was listening really carefully to the way the question was worded, and it's the way that these questions, I think, usually get worded, which is totally understandable. The listener wrote in referring to the quote problem with the VXX, the roll yield, or whatever you're going to call it. And as I think I've said before on the show, I mean, I really take exception with that way of thinking about the issue. I mean, in one sense, it is a problem. It's the same problem as the human condition, as the root of existence, which is just time slipping through our fingers. In finance, we call it the time value of money, and it's a real thing. Time is worth something, and while we usually think about time value of money in terms of 5-year versus 30-year fixed income, it's also worth something, and uncertainty is worth something at the very front end of that curve too. And so, look, a huge portion, whether it's VXX or VIX options or plain old S&P options, Apple options for crying out loud, all are affected by that time component and by that uncertainty component as you extend out in time. And so you're always going to confront this issue as long as you're working within this mortal coil. And so seeing VXX and its costs as a problem, I think, is not exactly right. I mean, it's just the nature of the world in which we function, that things cost money, linked to the passage and the square root of time. And so there's no real fix in any fundamental sense, because there isn't any problem in any fundamental sense. And the best we can do is come up with rules, whether in our life or in our investing, that try to keep costs down and give us a little bit of upside. Spoken
like the true degenerate philosopher that you are, sir. I would expect nothing less from you, sir. Well said. One more quick one here we got time for from Chris Hanks, writing to us from scenic Toledo. He writes, "Hola, volatility gang, and perhaps special guest. No guest today. You're just got us. I am a frequent listener and wanted to write in to say thanks for putting out this show every week." Well, you're welcome, Chris. He goes on to write, "My Mondays suck, but I get a nice little pickup on my commute when I download the latest episode of Volatility Views. I do miss Don's sold to you attitude, but I'm sure he'll get him back on one of these days. No one gets as fired up about selling vol as Don S., and that is indeed correct." He goes on to say, "Let me leave you with this question. Long term, which do you think will outperform? A dynamically hedged SPY at the money straddle or a dynamically hedged VIX straddle?" That's interesting. They should be roughly equivalent, but clearly they are not. Interesting question, Chris. This goes back to what we were just talking about the performance of these two. And you would think on the surface you'd probably want to lean SPY, but you're right. VIX has those moments, Mark, where you definitely want to capture those movements. And those are the moments where if you could capture those in a VIX straddle, you could probably do all right. So this interesting question. We'll start with you, Mark. Where do you fall on the straddle debate here?
I think it depends on what you let me use for a hedge. If you let me use S&P vol to dynamically hedge VIX, I'll bet you I can do a lot better.
That's kind of the question here. What the hell are you hedging with VIX?
If I'm forced to use the future, then it's probably 6 of one, half dozen the other.
That's kind of where I was leaning as well. I don't really want to touch the VIX future if I don't have to, but that would definitely make it a different beast.
For my deltas, then I can outperform with the VIX future, with the VIX option.
With the VIX option, yeah. Yep. Jared, do you agree again? Is this going to be a love fest on the show?
No.
Aha, there we go. Point, counterpoint.
No. All right. First of all, I think I'm not sure if you guys might be right, but it's not a priori right. I mean, there's this empirical question whether the convexity issue with, an SPX based hedge for short, volatility products is is good in the kind of really tail situations. I'd have to think about that and look at it, but I'm not sure what the answer is at the very least. But I would say, we looked into this over the summer in a paper, that the vol risk premium in VIX options, at least historically, has been larger in risk-adjusted terms than it has been for SPX options. Larger, in fact, than any other asset class that I could find. So we built a strategy around that, and people who are interested and want to know more should get in touch. And so
now, Jared, question, were you looking at kind of when you were messing around with straddles, were you looking at the one based on where the future was trading, or, and this would be another question for the guy, what are you using for your at the money? Are you using the cash? Are you using the future? Because, that's going to be kind of the same thing. But yeah, I hadn't thought about that. You're right. VIX option premiums are, you're basically putting an option premium on something that should have a premium to SPY. So right. I hadn't thought about that.
Well, so in this, the strategy that I was referring to, we're looking at, so these are like 1 month straddles, so there's not a huge difference between the spot and the future a lot of the time, but definitely taking the forward value of VIX for 1 month forward as your at the money strike. And then I track a delta hedged version of this, which performed actually pretty poorly most of this year, but rebounded in the summer. And then an unhedged version, which I think does actually a bit better. So but that's a great question. Man, I love the questions on the show.
Yeah, I was just thinking the same thing. We get the best thought questions here on this show. It's I love the audience for this program. They're a great bunch. So there you go, listeners. If you want to check out that strategy Jared has, check them out over there at BGC Partners, and maybe that has more info for you. But you're right. I'm kind of on the fence with you, Mark, that I think the way you hedge it is kind of where it all comes out in the wash, as it is with all options trades at the end of the day. How you hedge determines many, many things. All right, time for us to keep on rolling right on into our final segment. Time for the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, listeners, you know what time it is. It's time for us to dive into our wild, reckless, without any reason or regard for the consequences, prognostications for the week to come from a volatility perspective. And when you're talking reckless, when you're talking wild, when you're talking without any abandon to the consequences, you're talking Jared Woodard over there at BGC Partners. So, Jared, what's your wild and reckless prediction for the week to come?
It really does get worse every week. It's eventually going to be like, when it comes to violating every clause in Series 7, who do you think of? For the audit, it's informational and not investing advice.
Exactly. It's all just for fun.
Yeah, and I think like I said before, I think it's time to prepare for a change of regime, which doesn't mean necessarily the next several weeks or even, this fourth quarter necessarily, but there's a real emergent trend kind of under the radar in fixed income, currency, commodity vol that when it hits in a big way, I think is going to affect equities, not necessarily meaning a big crash or even a big correction, but I think we could get a move back into a moderate volatility regime, the kind we saw before 2012, starting next year. And so I think there's some things to do to prepare for that. One thing is to stop selling weekly options on a systematic basis.
That will never stop, Jared. The program, they can't stop selling those things.
So, that's one thing I've been thinking a lot about. But in the very short term, look, we got a nice vol pop and it's kind of already sold back off. But, maybe you get another month or two of easy times in the land of volatility selling, and cross your fingers that none of these geopolitical scenarios ever start to matter to the market.
All right, Mark, reckless prognostication time. What do you got for us?
I think the big thing you have to worry about is Hong Kong. If that gets really bad, that could be really, if something really wrong happens, the Asians are going to sell the Hang Seng down 5%, and then the S&P is going to fall down 2 or 3%, and things are going to get ugly. Now, without that, I'm in agreement with Jared. I think that you look at a 13 VIX is kind of toward the low end now, not an 11 anymore. And, we might be in that range of kind of 13 to 16. and moving toward a more normal 17% VIX. But for the coming week, I think you'll see a 13 handle, and we'll probably threaten 2,000 in the S&P.
Sounds good. All right, listeners, that's all the time we have for the Crystal Ball segments. Also all the time we have for this episode of Vol Views. But before we go, as always, let me check in with each of my cohorts here on the old Volatility Views panel, see what they're cooking up. That may interest you. I guess we'll start with you, Jared. You already plugged one of your strategies there. What else can people find if they head on over to BGC Partners?
Okay, two things. Anybody who's got positions focused in a particular equity sector, I've set up some nice screens that can go out to clients that show key stocks in each sector and where vol and skew and realized and et cetera levels are that people seem to like quite a lot for getting some quick analysis of where their stocks are relative to peers. Second thing, I'm working on a report looking at since 2009 the effects of IPO stocks after lockup expirations. And the results there were larger than I expected. So we're looking at some stocks that some IPOs that have lockups expiring later this year and some ideas based around that research. I'm pretty excited about that, and that'll probably come out in the next week or two.
That one sounds pretty fascinating. I won't mind once you get it out to the partners and everyone else. Maybe we can discuss a few salient details here on the show. I think that's pretty interesting stuff.
Thanks.
All right, Mr. Pitts, what's coming up in the land of Mark Sebastian? I think I have that backwards, but it still works.
You know what? We write a blog every day. Everybody go to optionpit.com/blog. It's worth the read. And we do a lot of good work on there. And if you got questions for me or Andrew or anything, you can email us, mark@optionpit.com. So that's all I got.
All right, good stuff. And on behalf of the Greasy Meatball and Jared, who goes without a nickname, I'll have to fix that, and of course myself, we want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show, and of course for sending in such great questions. You guys listening to Vol Views really are the best. Don't tell the rest of the listeners, but you guys really bring your A game when you send in great questions. Keep those coming. We love to hear from you, and we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. Or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.